Let's get straight to it. Managing your money isn't just about getting rich. It's about freedom. It's the freedom to quit a job you hate, the freedom to handle an unexpected car repair without panicking, the freedom to take a vacation without going into debt. Think of your money as an employee. Right now, is it working hard for you, or is it just sitting around doing nothing? When you don't manage your money, you're essentially letting it call the shots. You become a passenger in your own financial life, and that's a risky place to be. Taking control means you're the one in the driver's seat, telling your money where to go and what to do, building a future you actually want. Every dollar you earn has potential. It can be spent, saved, or invested. Most people just focus on the spending part. But what if you treated every dollar like a seed? Those planted seeds can grow into a massive tree that provides for you for years to come. That's what smart money management is. The word budget makes a lot of people cringe. They think it means spreadsheets, counting every penny and never having fun again. Let's smash that idea right now. A budget is not a financial prison. It's a freedom plan. All a budget does is tell your money where to go, before you get the chance to wonder where it went. It's about being intentional. So, how do you start? The simplest way is the 50-30-20 rule. It's a great starting point. 50% goes to your needs. These are the absolute must-haves: rent or mortgage, utilities, groceries, transportation, and insurance. 30% goes to your wants. This is the fun stuff: dining out, entertainment, hobbies, streaming subscriptions, and that new gadget you've been eyeing. Finally, 20% goes towards savings and debt repayment. This is the part that builds your future wealth. Let's use a real example. Imagine your take-home pay is $4,000 a month. Using the 50-30-20 rule, your budget would look like this. The beauty of this is its simplicity. You're not tracking 100 different categories. You're just making sure your spending fits into these three big buckets. Once you have a budget, the next step is to find ways to spend less, so you have more to save. This doesn't mean you have to live on ramen noodles. Let's start with the big three expenses for most people: housing, transportation, and food. For housing, if you're renting, could you get a roommate? For transportation, if you live in a city with good public transit, could you use it more often? Biking or walking for short trips is not only free, but also good for your health. For food, the biggest money saver is simple: cook more at home. Eating out and getting takeout is a huge budget killer. Look at your recurring subscriptions. Are you really using that gym membership, all those streaming services, and that fancy subscription box? Be ruthless. Call your provider and ask for a better deal, or shop around for a cheaper plan from a competitor. A 10-minute phone call could easily save you $20, $30, or even $50 a month. Having a budget is step one, but a budget is just a plan. Step two is tracking your expenses to see if you're actually following that plan. This is the part that opens your eyes. You might think you only spend $100 a month on coffee, but when you track it, you might find it's closer to $250. There are tons of free apps like Mint, YNAB, which stands for You Need a Budget, or Personal Capital, that connects securely to your bank accounts and credit cards. Let's be real, the first month you do this might be a little shocking. You'll uncover spending habits you didn't even know you had. That daily energy drink, the subscription you forgot you signed up for, the late-night online shopping sprees. It all adds up. The key is to make this a regular habit. Check your tracking app once a week. Just spend 10 minutes reviewing your spending. This weekly check-in keeps you accountable. Expense tracking transforms your budget from a theoretical document into a practical, real-time tool for building wealth. It turns guessing into knowing, and that knowledge is power. Saving money without a goal is like driving a car without a destination. You're just wandering aimlessly. You need a why. These goals need to be specific, measurable, and have a deadline. I want to save more money is not a goal, it's a wish. I want to save $5,000 for a down payment on a car by this time next year is a real, actionable goal. It's best to break your goals down into three categories: short-term, mid-term, and long-term. Short-term goals are things you want to achieve in the next 1 to 2 years. The most important short-term goal for everyone is building an emergency fund. This is 3 to 6 months' worth of essential living expenses saved in a high-yield savings account. This is your financial safety net. If you lose your job or have a medical emergency, this fund will save you from going into debt. Midterm goals are typically for the next 3 to 10 years. This is where bigger life events come into play. Maybe you want to save up for a down payment on a house. Long-term goals are for 10 years or more, with the biggest one being retirement. This might seem incredibly far away, but the magic of compound interest means that the sooner you start, the less you have to save. Saving for retirement is a marathon, not a sprint. This is where you absolutely should be investing your money in things like a 401k or an IRA. By setting clear goals in each of these categories, you create a complete financial roadmap. You know exactly what you're saving for and why, which makes the entire process of budgeting and saving feel meaningful and, dare I say, exciting. Okay, so you've got your budget, you're tracking expenses, and you're saving money. That's awesome, but saving alone won't make you wealthy. Why? Because of a sneaky little thing called inflation. Inflation is the reason a candy bar that cost 25 cents when you were a kid now costs $2. To truly build wealth, you need to make your money grow faster than inflation, and the way you do that is by investing. Investing is simply putting your money to work to make more money. Think of it this way. When you save, you are putting money aside. It's safe, but it's passive. When you invest, you are buying a piece of something that has the potential to grow in value. You are becoming a part owner in the success of businesses and the economy. It's the difference between storing your seeds in a jar and planting them in a field where they can grow. Yes, there's a risk, but over the long term, a well-tended field will produce a harvest far greater than the seeds you started with. The most powerful force in investing is compound interest. Albert Einstein supposedly called it the eighth wonder of the world. Here's how it works. You invest some money, and it earns a return. The next year, you earn a return not just on your original money, but also on the return you earned last year. It creates a snowball effect. This is why starting early is so important. Someone who starts investing $200 a month at age 25 will have significantly more money by age 65 than someone who starts investing $400 a month at age 40. So you're ready to invest. But in what? Let's break down the basic options without any confusing jargon. The most common investment is a stock. When you buy a stock, you are buying a tiny piece of ownership in a single company, like Apple or Amazon. If the company does well and makes a lot of profit, the value of your stock can go up. If the company does poorly, the value can go down. Buying individual stocks can be risky because your success is tied to the fate of just one company. This is where funds come in. A fund is like a basket that holds many different investments. Instead of buying one stock, you can buy a share of a fund, which gives you instant ownership in hundreds or even thousands of companies all at once. This is called diversification, and it's the single best way to reduce your risk. If one company in the fund does poorly, it's balanced out by all the others that are doing well. The most popular type for beginners is an index fund. An index fund simply aims to copy the performance of a major market index like the S&P 500, which represents the 500 largest companies in the US. Let's make this super simple. Buying a single stock is like betting on one horse to win a race. It's high risk, high reward. Buying an index fund is like betting on all the horses in the race. You won't get the massive payout of picking the one winner, but you're almost guaranteed not to lose everything. Beyond stocks and funds, there are other options like bonds. A bond is essentially a loan you give to a government or a company. In return, they promise to pay you back your money after a certain period, with interest payments along the way. Then there's real estate, where you can buy physical property to rent out or hope it increases in value. Each option has its own level of risk and potential return. But for now, just focus on understanding the power of low-cost index funds. That's your starting point. You don't need a complex strategy to succeed in investing. In fact, for most people, the simpler, the better. The best strategy for a beginner is called dollar cost averaging. This sounds fancy, but it's incredibly simple. It just means you invest a fixed amount of money on a regular schedule, like $100 every month, no matter what the market is doing. This automatic approach takes the emotion out of investing. You're not trying to time the market, which is nearly impossible anyway. Why is this so powerful? because it stops you from making the two biggest mistakes investors make: buying high out of greed and selling low out of fear. So where do you actually do this? You need to open an investment account. For retirement, the best places to start are tax-advantaged accounts like a 401k or a 403b, especially if your employer offers a match. An employer match is free money. If your company matches 100% of your contributions up to 5% of your salary, you should absolutely contribute at least 5%. Not doing so is like turning down a raise. Companies like Vanguard, Fidelity, and Charles Schwab are excellent choices for beginners. They offer a huge selection of low-cost index funds and ETFs, exchange-traded funds, which are similar to index funds but trade like stocks. You can set up automatic transfers from your bank account to your brokerage account every month. Pick one or two broad market index funds, like a total stock market index fund, set up your automatic investment, and then, this is the most important part, leave it alone. Don't check it every day. Just let your strategy do its work over the years. We've covered a lot, from budgeting and saving to the basics of investing in the stock market. It might feel like a mountain of information, but you don't have to climb it all at once. The journey to financial freedom is taken one step at a time. The most important thing you can do is to start today. Not tomorrow, not next week. Today. The power of compounding means that the single biggest factor in your success is time. Every day you wait is a day you lose that your money could have been working for you. So what is one simple, actionable thing you can do right now in the next 10 minutes? Pick one of these. First, you could download a budgeting app like Mint and connect your bank account. Just see where your money has been going. Or second, you could go to your bank's website and set up an automatic transfer of just $25 from your checking account to your savings account every week. It's a small amount, but it builds the habit. Or third, if you have a 401k at work but haven't signed up, go to the HR portal and enroll right now. Just start with 1%. You can always increase it later. The key is to build momentum. Small wins create confidence. Once you see that you can save $100 a month, you'll start looking for ways to save $200. Once you make your first investment, the fear of the unknown disappears, and you'll be more comfortable investing more. This is not about becoming a financial expert overnight. It's about building simple, positive habits that will completely transform your financial situation over the long term. By taking control of your finances, you are giving yourself the greatest gift possible, the freedom to choose your own life path. You are building a future where you are not controlled by debt or financial stress. You are building a life of security, opportunity, and peace of mind. So take that first small step. Your journey to financial freedom starts now.